Okay, let's unpack this. You know, when most people think of the Cheesecake Factory, well, they picture the huge menu, right? The
Oh,
fancy
yeah.
dining rooms.
And that dessert case, of course.
Exactly. But
Yeah.
today, we're going to put the brown bread and the cheesecake, maybe just for a bit, aside.
Mhm.
We're doing a deep dive into the Cheesecake Factory Incorporated TCF.
Right.
Trying to understand how they really operate,
Yeah.
as this multi-brand, um, really successful business machine.
And pulling it all from their own words, basically, from the annual report.
That's the plan, the
Yeah.
strategy, the financials, it's all in there.
Yeah, exactly. And our position really is to pull out those key nuggets. Like,
Gotcha.
what's the operational strength? What are the strategic pillars for growth that explain how they do it?
Right. And how did they pull off 2024?
Well, if you look at their 2020 performance, I mean, the results are pretty big headlines.
Okay.
TCF hit record annual revenue, $3.6 billion.
Wow. Right?
Record revenue. And they opened a record 23 new restaurants across all their brands.
23. That's quite a clip.
It is. And maybe the most telling thing for investors, adjusted earnings per share.
Hmm.
They just soared.
Okay.
Up 28% year over year, landing at $3.44.
28%. Okay, those
Yeah.
numbers are definitely swimming against the current in, the casual dining space right now.
They really are.
So let's break down that $3.6 billion. You said multi-brand, so it's not just the main Cheesecake Factory restaurants driving all of that anymore.
Not entirely, no. Though the flagship brand, TCF itself, is still definitely the financial anchor.
Okay.
They have 215 of those restaurants. And they operate in what the company calls the upscale casual dining segment.
Upscale casual. What does that mean exactly? Is it just pricier?
It's partly price, but it's also positioning. They specifically set themselves above, say, core casual dining, like your Applebee's or Chili's. They're aiming for service, atmosphere, operational standards that are, well, closer to fine dining.
Right, got it. And financially, that high-touch upscale positioning, it must translate into some serious cash per restaurant.
It absolutely does. Their average annual unit volumes, AUVs, hit an industry-leading $12.3 million per restaurant in 2024.
$12.3 million
Yes.
per year, per restaurant.
Per restaurant, yeah. And just to give you some perspective on that, that's easily double, maybe triple, what a lot of other big casual dining chains manage to do.
That's incredible. So that volume, that $12.3 million number, is that sort of the bedrock of their whole strategy for the main brand?
It's everything. That's the entire strategic foundation. That staggering AUV is what lets them justify and, frankly, sustain their really high-cost operational model.
Which we'll get into.
Exactly. And it's also just a massive barrier to entry. Think about trying to compete with that scale and complexity.
Yeah, good point. But okay, future growth.
Yeah.
You said they opened 23 spots. Are they all TCF locations?
No, and that's where it gets interesting. The immediate energy, the real unit growth driver, it's coming from the diversified portfolio, specifically from Fox Restaurant Concepts, or FRC, which they acquired.
FRC, so this is like TCF's innovation lab.
Yeah.
Testing new ideas.
That's a perfect way to put it. FRC acts as an incubator. They develop, test, and then scale new restaurant concepts, often with, different footprints, different menus, different economics.
And how did those FRC brands do in 2024?
They were the hypergrowth drivers. So North Italia, which now has 42 locations, their sales jumped a huge 16% year over year.
16%.
Yeah. Then there's Flower Child, 38 locations, up 14%.
Also strong.
And then the other FRC brands category, this includes places like Culinary Dropout, the Henry Blanca, they also saw 14% sales growth across their 49 spots.
Wow. Okay, so those growth rates, 14%, 16%, they completely dwarfed the, 3% sales increase at the legacy TCF restaurant.
That's right, just 3% for the core TCF segment.
So that really tells you the diversification play is working, at least as a unit growth engine.
Definitely.
But I imagine the economics, the sales per restaurant must be different for these newer FRC places compared to that massive TCF number.
Oh, very different, yes. While the big Cheesecake Factory locations are pulling in that almost $12.4 million figure.
The other FRC brands averaged about $6.4 million in sales per location in 2024.
Still good, but roughly half.
Exactly.
Yeah.
And that difference isn't necessarily surprising. These FRC concepts often have smaller footprints, maybe less operational complexity than the huge, Cheesecake Factory experience.
Right.
But it does highlight just how unique financially that core TCF concept really is. That $12.3 million is an outlier.
So looking ahead, they're leaning into this multi-brand thing even more. What's the plan for 2025 openings? You'd said maybe 25 new restaurants?
As many as 25, yeah. And the mix really shows the strategy shifting.
How so?
Well, they're only planning maybe 3 or 4 new Cheesecake Factory locations,
Only 3 or 4.
but
Okay.
then 6 to 7 each for North Italia and Flower Child.
Ah, leaning into the growth engines.
Exactly. Plus another big chunk, 8 or 9 new spots coming from that other FRC category.
Got it. So heavily leveraging that diversified pipeline for expansion.
That's the clear picture.
Great.
Plus, they mentioned potentially up to 2 new international licensed locations as well. Okay, here's where it gets really interesting for me. The operational blueprints.
Yes.
How do they actually do it? How do they maintain those high standards, that upscale feel, and handle those crazy volumes? I mean, their menu is famously enormous.
Yeah, it's one of the broadest in upscale casual dining,
Nice.
and that operational intensity. That's their strategic moat, you could say.
Okay.
And here's, I think, the really critical detail from the reports. Substantially all menu items, except for the desserts that come from their bakery,
Uh-huh.
they are prepared from scratch, daily, in the restaurant kitchen.
Scratch cooking daily for that huge menu.
Using high-quality, fresh ingredients right there on site. Think about what that requires.
Extraordinary kitchen staff, huge kitchens, complex supply chains.
Exactly.
But why? I mean, most chains, even fancy ones, have moved toward central commissaries or buying pre-prep stuff to cut labor, simplify things. Why stick with scratch cooking?
Well, the sources suggest it's 2 main things. First, it really is about control. Control over creativity, control over quality. That feeds directly into that upscale brand promise.
Okay, makes sense for the brand image.
And second, it's actually about the bottom line, believe it or not.
More profitable to do it the hard way.
It seems so. The argument is that the operational efficiencies they gain from handling that much volume, remember the $12.3 million per unit?
Right.
That volume helps offset the higher labor costs of scratch prep. They believe that consistent, high-quality food drives loyalty and lets them keep that important pricing power.
Okay. Speaking of pricing, how did they handle the crazy inflation we saw recently?
Yeah.
Food costs, wages.
Yeah, that was a big challenge. Historically, they aimed for pretty modest price increases, maybe 2% to 3% a year. But in 2023 and 2024, the reports say they took price increases above those historical levels. They had to, really, to try and offset those significant cost pressures.
That's a tricky balancing act, though.
It's a very delicate tightrope walk, exactly. You need to protect your margins, but push pricing too hard. And you could scare off customers or see them, trade down on the menu.
Right. Let's talk about another big piece of the operation, the bakery. Those cheesecakes aren't just a menu item, right? It's like a whole separate infrastructure.
It is, and it's entirely strategic. They run 2 massive bakery production facilities, one in California, one in North Carolina, and they're planning a 3rd one in Indiana.
Wow. 3 factories just for desserts.
Well, mainly for the cheesecakes. They produce something like 60 different varieties. And here's the key insight. The company explicitly states that this vertical integration, making it all themselves, it's actually more profitable than just outsourcing the dessert production.
Interesting. So, control and better margins.
Seems to be the case.
And that bakery.
Yeah.
It does more than just supply the restaurants, right? Isn't there another angle?
There is. It's a really smart secondary revenue stream. They leverage the brand name outside the dining rooms. They sell their cheesecakes and some other baked goods internationally in about 15 countries now,
Okay.
and also to third-party customers domestically. Think supermarkets, warehouse clubs, under the Cheesecake Factory at Home brand.
So they turned that core baking skill into a whole separate licensing and wholesale business.
Precisely. High-margin business leveraging an existing asset and brand recognition.
Okay, so back to the restaurants.
Hmm.
To pull off this level of complexity, scratch cooking, huge menu, high volume gala, you absolutely need a highly skilled, stable workforce.
You really do. And their commitment to their staff, their human capital, it gets recognized. They were named to Fortune's 100 Best Companies to Work For again in 2024. That was the 11th year in a row.
11th year. That's impressive consistency.
It is. And that stability is crucial for quality control. Get this. Their general managers and their executive kitchen managers, they average more than 10 years of experience with the company.
10 years in restaurant management. That's almost unheard of in this industry.
It's extraordinary, especially in that kind of high-pressure, high-volume environment.
But building that kind of stability, it must cost a fortune up front, especially when opening a new restaurant, right? training alone.
Absolutely. The pre-opening costs are substantial because the training required for that complex menu and service model is so extensive. The reports state it averages $1.0 million to $1.5 million just to open a typical location.
1 to 1.5 million.
You-
Before they even sell a slice of cheesecake.
Exactly. This is not a concept you can roll out cheaply or quickly.
Okay, but maybe we can connect the dots here. That high manager tenure, the stable staff, does that actually help make that huge $1.5 million upfront investment make sense? Like the training cost is massive, but if you keep people for 10 years,
That's got to be the strategic calculation, right? The high retention stabilizes everything. It ensures the consistency that keeps people coming back and spending enough to hit that $12.3 million AUV.
so the investment is steep, but the payoff in long-term efficiency and quality control, it makes the numbers work.
Apparently so. It underpins the entire model.
Okay, one last operational point before we look at the investor side.
Yeah.
How people get the food is changing, right? Takeout, delivery, off-premise is huge now.
It's definitely a significant chunk. For the main TCF restaurants, off-premise sales made up 21% of their total sales in fiscal 2024.
21%. So $1 out of every 5 is eaten outside that fancy dining room they invest so much in?
That's the number, and they're actively trying to manage that customer relationship beyond the restaurant walls, too. They launched their loyalty program, Cheesecake Rewards, nationally in mid-2023.
Ah, the rewards program. What's the goal there? Just discounts.
Not just discounts. The report emphasizes using data analytics from the program to drive incremental sales, understand customer habits, target offers, build loyalty.
Got it. Okay, let's pivot. Let's look at this from an investor's perspective. We have this, operationally complex but seemingly successful machine hitting record revenues.
Right.
But how has the stock actually performed? Does the market love this story?
Well, that raises a really interesting question about market perception versus the operational reality on the ground.
How so?
The sources included a stock performance graph. It showed that if you invested, say, $100 in TCF stock at the end of 2019, by the end of 2024, you'd have about $123.
Okay, so 23% return over 5 years. Positive, but.
It significantly lagged the major indexes over that same period. The S&P 400 Mid-Cap Index, for example, turned that $100 into $151.
Ouch.
And the NASDAQ U.S. Benchmark TR Index, that soared to $193.
Wow. Okay, so investors are clearly seeing some risks or maybe some structural issues here, despite those amazing unit volumes and record revenues.
It would seem so. They're weighing something else.
What are the big risks that TCF themselves highlight in their reports?
Well, beyond the ongoing sort of economic volatility, managing inflation, commodity costs, wages without alienating customers.
Which we talked about.
Right. There are two really critical modern risks they specifically called out. One is technological vulnerability.
Cybersecurity, things like that.
Exactly. They rely heavily on IT systems, both their own and from third-party vendors. And we saw a really stark example of this risk back in July 2024.
What happened?
There was a software update from a company called CrowdStrike. It caused these massive, though brief, IT outages globally for many companies, and for TCF, it directly impacted their ability to process customer payments at some restaurants.
Yikes. Yeah, that hits cash flow immediately. Okay, that's one risk. What was the second?
The second one is fascinating, I think. It's about changing consumer preferences, specifically linked to new medical treatments.
Medical treatments affecting dining. How?
The risk factor section explicitly flags the company's potential inability to adapt quickly to evolving dining preferences, and it specifically mentions the potential impact of GLP-1 agonists.
The LP1s. Okay, for listeners maybe not familiar, these are the new generation of really effective weight loss and diabetes drugs, right? Like Ozempic, Wegovy.
Exactly those.
So how does that threaten a restaurant concept famous for, let's be honest, huge decadent portions and cheesecake?
Well, that's the potentially profound strategic threat, isn't it? TCF's entire operational success, that $12.3 million AUV, it relies in part on the concept of generous portions, high volume, often high calorie dining experiences.
Right. It's part of the appeal, the value proposition.
But if GLP-1 drugs become really widespread and adoption is accelerating fast, it could fundamentally change many consumers' relationship with food.
How so?
These drugs often reduce appetite significantly. They can drive aversion to large portions, shift preferences towards lighter, maybe healthier options. So this forces a company like TCF to figure out how to keep its volume and appeal while potentially needing to adapt its menu, maybe shrink portion sizes, which could undermine the very identity that made it successful.
Wow. Yeah, that's a much bigger challenge than just tweaking a recipe. That goes to the core of the brand identity and the unit economics.
It really does. It's a fundamental shift to watch.
Okay, one last area, international. They mentioned a couple of new licensed locations planned. How does that side of the business work?
Yeah, they currently have 34 licensed locations operating internationally as of early 2025. It runs on a licensing agreement model.
And the challenges there.
Mostly consistency and logistics, according to the reports. Maintaining product quality, especially for the cheesecakes.
Ah, because the cakes are made here.
Entirely. The
Okay.
cheesecakes are all manufactured in their U.S. bakeries and then exported.
Wow, exporting frozen cheesecakes globally.
Exactly. So you've got complexities in maintaining that quality, dealing with different local regulations in each country, managing the cold chain logistics. It's not simple.
Doesn't sound simple at all. Okay,
Yeah.
so let's try to bring this all together.
Yeah. So what does this all mean for you, the listener?
I think the core conclusion is that the Cheesecake Factory Incorporated is, well, it's an incredibly operationally complex, high-volume machine.
Right.
Its continued success seems to hinge entirely on maintaining those massive unit volumes. That $12.3 million figure is key.
Because that justifies the costs. It justifies the huge build-out costs, the extensive training, the whole scratch cooking model. And looking forward, their future unit expansion is very clearly and strategically focused on leveraging that faster-growing, more diversified FRC portfolio.
That's a great synthesis. The sources really paint this picture of a company totally committed to this high investment, high touch, what they call experiential dining model.
Absolutely. The big dining rooms, the service, the complex menu.
Yet, those same sources show us that, 21% of TCF sales are now coming through the off-premise channel. Takeout, delivery, focus on convenience, not the in-house spectacle.
Exactly. And then you overlay that with the potential disruption from consumer trends like the GLP-1 drugs we discussed, which directly challenges the sort of caloric premise of the traditional experience.
It really sets up the ultimate tension, doesn't it?
Yeah.
Which leads me to the provocative thought I'm kind of left wrestling with here.
Okay.
Given the huge capital investment they make in these customized, experiential, full-service locations designed for that high-touch experience, and given the simultaneous, ongoing, maybe accelerating shift by consumers toward convenience, that 21% off-premise number, and changing health consciousness,
Yeah.
how rapidly will the existing unit economics change if the average customer increasingly prefers the convenience of that 21% off-premise channel over the full, high-overhead, in-restaurant spectacle that currently generates the other 79% of that $12.3 million in revenue?
That is the multi-million-dollar question, isn't it? Their ability to pivot that incredible operational dedication, the scratch cooking, the intense training, the whole system to support what might be a structurally changing demand landscape.
Yeah.
That's probably going to be the defining challenge for them over the next decade.